Hey guys, Toby Mathis here, one of the founding partners at Anderson Business Advisors. I'm a tax attorney and I'm a real estate investor, have been for more than 2 decades. And unfortunately, because of that, I look at things by the numbers instead of just emotionally. And the numbers on rental property is where people get in trouble all the time because they're acting with their gut instead of crunching numbers. So I'm going to teach you how to crunch some very easy numbers to keep you out of trouble. You can thank me later. Some of you guys are going to be like, no, I want to argue with you. Trust me, I see what happens when people try to buck obvious things. Now, here's an easy one. If I have more money going out, so I'm paying money out, so I'm just going to use that as red. If I'm paying money out than I'm bringing in, then I have what's called negative cash flow. And this is going to be bad. We're just going to call it bad. Don't do that. Pretend that you're the dog, that you're taking stuff off the countertop. No, don't do that. Don't do that, right? The money that goes in, positive cash flow, equals good, right? This is obvious. But how do we know without buying the property? How do we know what it's going to be? It's an easy test. What you do is you focus on gross rents on a property. And you just cut it in two. Any property, you take the gross rents, cut it in two. And that's going to be about what you get. I'm just telling you, after doing tens of thousands of these and looking at tons of portfolios, and again, I own over 200 properties myself, this is about right. Now, you can move this number if you build your own property, for example. It's going to be closer to 65 to 75% that you're actually getting to keep. But when you're doing rental properties, this is the easiest way to make sure you never get burned, is just to say, if my gross rents, for example, let's say I have $2,000 a month that's coming in. So my gross rents are $24,000 a year. I'm just going to cut it in two, which means I have $12,000. That's going to be about my net operating income. So they call that NOI, net operating income. Out of that, I have to be able to cover my debt service. So let's just say that property was a $250,000 loan. I don't know what the property is worth. Let's just say it's $270,000, or maybe you bought it all no money down, right? That's the big thing. So $250,000, let's say I'm buying 5%. What would that end up being? That's about $12,500 a year in interest. Guess what we know now? Which one is more, right? We don't want wiggle room, right? Now we have a negative amount. That's actually 12,000. Pretend that's a 12, right? We would say pass on that one. That's probably not going to be the best deal because I have more money. It may not be much, but it's still negative cash flow. We're still not going to want to touch that one. Too close to the edge. Now, some of you guys are going to say, well, I like using leverage and all these things. I'm just going to say, having done this for more than 2 decades and having worked with quite literally tens of thousands, our firm has 250 people in it. This is what we do. We see this all the time. This is where we get into trouble. You want to have lots of wiggle room, lots of liquidity. You want to have a lot of positive cash flow coming in and avoid these negative cash flow situations, because these ones are what will absolutely kick you in the hiney if the market changes or if you have vacancies. Like, this property is going to be ugly if I have a tenant sue me for mold, not pay rent, sit on their heels, destroy the property, mess with it, you name it. If I can't use that property in about 6 months, that's going to really, really hurt. I won't necessarily be able to recover from that unless I have a really good job someplace else. It's going to suck all my other positive cash flow. And that's where people get into trouble. That's what we saw in 2008, 9, and 10. That's what we've seen every time there's a little bit of a hiccup in the market. Where people get themselves in trouble is when they don't have that positive cash flow coming in consistently and it's too close. So I would pass on this one and make it really simple. What type of deal would I buy? The easiest way and the most simple way is to buy things cash in the beginning. And that way we don't have to worry. We just have our net operating income. In worst case scenario is I don't have money coming in off of it. Best case scenario is I have lots of money coming in off on it. And I use that money to accumulate and buy other properties, which means, yes, I'm saving up for properties. Some of you guys want to buy first, figure this out later. No, figure this out first, then buy, and make sure you're in a position to withstand any negatives. And the best way to do that is to buy good properties that are in the, let's say, $70,000 to $150,000 range. It's really tough to buy things at $200,000 that are going to work just because of that. And if you don't know where to find those properties, by all means, contact us and we'll show you the right places to be looking. We'll put you in touch with people that do that day in and day out. There's a ton of them in working class America where they're steady cash flow machines. But you buy those cash, the best thing in the world is buying things with very little debt on them. You're going to be so much happier, so much freer. You're not going to have to worry about having to pay the bank if you're keeping any debt service to a minimum. Do that and you're going to be successful. So how do I crunch those numbers? The easy way is I take my gross rents, divide them by 2, and that's really going to be close to what my net operating income is. Then I factor in what my debt service is. And I want to make sure, like if I was going to give you the best rule of thumb, I would say that your debt service, the amount you pay for interest, should be no more than 25 to 30% of your gross rent amount, which will keep you out of trouble. The best scenario is just to buy your first properties cash and keep yourself out of trouble so that in the future, if you have leverage, you have a bunch of cash flow properties already bringing in the cash so you can stomach any downturns in the market. Do that and you'll be successful.